There's a famous saying on Wall Street, sell in May and go away. Even though it rhymes, is it actually true? Is this wise advice to follow? I've got the latest on that mantra. Whether it makes sense for you, that and more coming up. Do you have an investing mantra? Maybe a saying that helps you reset or helps you maybe manage emotions in the right moment? I'm a travel baseball coach, and so I tell the kids, hey, even after one swing, got to reset. What do you say to reset after a bad play, something like that? Well, do you have one, whether after a bad play or good play, in your investments? And there's a lot of them, right? There's stocks climb a wall of worry, right? So as you start seeing threatening news headlines, okay, nope, stocks climb a wall of worry. Don't fight the Fed. That's another one. That's pretty good advice when the Fed says, hey, we're gonna hit the bazooka. We're gonna print $5 trillion, even if you disagree, like I did. Listen, the market loved it, so no use fighting the Fed, sort of thing. What about buy the rumor, sell the news? This is, I don't know if you're familiar with this one. This is an interesting one. I would absolutely say this one, it rings true a lot, and that is the rumors of, well, could this happen? Could this happen? Could this happen? Often that speculation, depending on what it is, will drive the price higher. And then all of a sudden the event that everyone speculated about finally is announced and the stock will go down. And then of course the tried and true, stay the course. And you might not even say, well, that's not a Wall Street saying. Yeah, no, it's an investing mantra for sure. I remember a client long ago is not a savvy investor, not someone that would even call himself financially successful, but they have saved up a lot of money. And when I first got to meet him, he said, oh yeah, I learned about saving and investing from my uncle. And when I would talk to him, he said, Bill, we always stay the course. We stay the course. We stay the course. And so anytime, bad news, market goes down, stay the course. Bad news, this thing could happen, this war, stay the course. And it has helped him sidestep a lot of emotions and a lot of temporary downturns, even the most challenging. I've been helping this family for several decades. We've seen some awful bear markets, and he's always stay the course, stay the course. So there are a lot of investing mantras or phrases out there. I'd be curious, which one's your favorite? Which ones do you follow? Leave those in the comments below. There is one. I don't know when you're digesting this content, recording it early part of May, and there is one related to this time of year that some people still live by. And the mantra is sell in May and go away. That's the phrase, right? So sell in May and go away. Catchy, right? And rhymes. Is there any truth to it? And is this something that you should follow? Well, I've shared here on this channel a lot of analysis on trends of the overall stock market. We've talked about presidential theory and whether election years are good years to invest. And we've looked at the data. We've looked at history with that. We've looked at, okay, well, should you not invest in September and October? A lot of bear markets and really nasty stuff has happened that time of year. Do you, the January effect, do you sell in December? Do you buy back in January? That sort of thing. And we've analyzed all of those things, but I don't think we've ever analyzed the sell in May and go away. And this is decades old. This phrase, it goes back decades, and it has to do with, well, typically, like this is true. And yeah, there's a lot of like lure about this and whatnot, but that a lot of traders on Wall Street, when summer hits, they don't work as frequently, and therefore there's less trading activity, and therefore, yeah, there's going to be more muted time periods during the summer because these traders in New York City, they might take a week in the Hamptons or whatever, and therefore just take the summer off. Not a lot happens. That hasn't been true in the most recent history and for the past couple of decades. This is a phrase, while it rhymes, and it might be rooted in something that may have been true once, it appears to not be true right now. Now, that doesn't mean that past performance is any guarantee of future performance. Things could change at any time, and there are other circumstances, other forces at work. But let's just take a look at the past few years in May. Last May, 2025 was a fantastic month in the market. And of course, we were coming off of the tariff tantrums. And so we had some rebound and recovery from that, but fantastic May 2025, very good May of 2024. And then this is where the history sort of, it comes in. May of 2023, 22, and 21, very muted, okay? And if we stretch this analysis back further, I'm not going to show you any charts on this, too much data, but if we stretch it back further, looking back decades, yeah, the period from May and over the next 4 months or so does tend to be a lower overall return than the pockets outside of that, but it's still positive. On average, when you look back over history, still a good time to invest, even though there may not be significant gains. And yet at the same time, you got to couple that with what we saw May of last year and May of 2024. Taking a look at this chart, if we go back 10 years, and you mapped out, well, what if you just stayed invested over the past 10 years? And what if you sold in May and got back invested in January of the next year? This really tells the story here. And I mean, take a look at the rebound in 2020, the surge that occurred, from March, second half of March, but yes, continued through the rest of the year. So you really missed a lot of that. The growth in the second half of 2021, you missed meaningful advances throughout, not just May, but throughout the sell in May and go away. So for the rest of the year in 2020, 21, 23, 24, and 2025. So certainly over the past decade, you can see just how much following this sort of rule, or even loosely following this rule, would have been detrimental to your overall portfolio. So let me introduce a new phrase for you. Maybe one you've heard us share before, but instead of sell in May and go away, a phrase always to level set your financial approach or your investing approach. How much offense and how much defense should you be playing in your investments? And I wouldn't answer this question based on emotions, but that's where I'd want you working with your certified financial planner, looking at all 6 areas of your financial life. Because if you're investing and saving for a goal, for a purpose connected in your financial plan, not just investment planning in and of itself on an island where, I just want to maximize my return. Everyone wants to do that, of course, but there's risk and reward. That's where you've got to connect your investment strategy, your investment plan with your retirement plan, with your cash flow, with your tax plan, with the rest of your financial picture, and decide how much offense should you be playing and how much defense should you be playing. Howard Marks, legendary investor, has said that is the most important financial decision every investor needs to make. Kevin Korhorn, founder of Korhorn Financial Group, has said it differently, but has said the same thing. This is the most important financial decision that you make, and that is, it's determining, or it drives your overall allocation, okay? Your overall stock bond ratio, how much large cap, how much mid cap, how much small cap, how much international, how much emerging, how much real estate, how much bonds, right? That drives how much offense and how much defense. Whether the stock market's going gangbusters, whether it's just had a big decline, whether it's in May, whether it's in September, you need to have an understanding of how much offense am I playing and how much defense, and does that fit and connect with your overall financial plan. I will also add, the old way, and I'm saying old for a reason, the old way of defining offense and defense has just been to diversify your investments. I've got a mix of stocks and I've got a mix of bonds, and the stocks are my offense and the bonds are my defense. I don't believe that is the approach that everyone should be taking when they're playing offense and defense. There are times, when we've just been through it, where bonds don't play a lot of defense. You're using them for diversification. I need them to show up because the stock market's very volatile right now, and guess what? Bonds are just as volatile, and they decline even when you're relying on them to add some complement, some stability. They may not do that. Instead, I would look at that overall diversified portfolio, but then I would look to say, well, are there other strategies that add more, sorry for the jargon, correlation benefits, meaning when stocks go down, these areas, these other strategies will actually be stable or they'll advance. Is there a way? Are there other strategies that you should be adding to that offense and defense equation to have you get more offense when times are good and have you play stable defense and reliable defense when you need it the most? Work with your certified financial planner. I would not follow the old mantra, sell in May, go away. It has not panned out. Rather, how much offense should be playing in your portfolio and how much defense, and what tools are you using to accomplish both of those? Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.